All right, let's take 10 and talk about qualified opportunity zones. A lot of people have heard of them. Not a lot of people actually understand what they are.
Yeah, we're excited to have a guest with us today, Nick Rosenthal with Griffin Capital, whose company is very familiar with these types of funds and investment opportunities. So, Nick, welcome.
Thank you. Great to be here with you guys. Love the format and excited to talk subchapter Z of the tax code.
We're going to make this a little bit more exciting than what it may sound right off the bat. But, talk to us for a second. What are qualified opportunity zones?
Sure. So opportunity zones themselves are just census tracts, and they were designated by the governors of each state in order to facilitate private sector investment into those areas. And effectively, opportunity zones were ushered into the tax code in 2017 in the Tax Cuts and Jobs Act. And effectively, the impetus, as I said, was to get capital gains sitting on the balance sheets of Americans, estimated about $6 trillion, to provide sufficient motivation to those investors to part with those gains and invest them long-term in these communities. And there are several benefits associated with doing so. So effectively, what the tax code says is that you can take a capital gain of any kind, short or long, and as long as you invest it in a timely manner, and it wasn't generated with a related party transaction, so father selling to a son,
right.
Effectively what you're able to do is defer the liability on that capital gain out until the end of 2026, at which time you get to reduce that liability by 10% when that tax is now due. And as long as you stay invested in an opportunity zone for 10 years, the growth on the underlying investment can then be taken out tax-free. So effectively, if I have $1 million capital gain that I realized today from the sale of securities, a business, art, wine, whatever it is, short or long term, I can defer paying that capital gain until 2027 when I pay my 2026 tax, at which time I'll owe tax on $900,000, not the $1 million. And then after 10 years of being invested, whatever my $1 million grew to in that opportunity zone fund, I get tax-free growth on. So we have not seen this combination of benefits in the tax code until subchapter Z was ushered in 2017. It's really transformative for people that are having liquidity events or thinking about having liquidity events.
What about for those folks who are thinking, well, I don't necessarily want to invest in an area that's low income because it might take, that's a pretty big bet. Is that area going to turn around, in the next 10 years? Is my investment going to be a good investment, right?
Sure.
Can you kind of go into what you guys are looking at there?
So there's a broad spectrum of opportunity zones in terms of where they stand from an economic prowess perspective. So if you think about what happened, the governors of each state were given the opportunity to designate opportunity zones based on certain criteria, effectively 3 criteria. 1, median household income had to be 80% of that or lower than the median household income in that metropolitan statistical area. Poverty rate had to be 20% or greater in that census tract, or they could select up to 5% of the adjacent census tracts that qualified next to the other 2 so that people could invest into the path of development. But the last census was done in 2010.
Yeah.
And the governors of each state designated these 8,400 plus opportunity zones again in the summer of 2018. So you have a pretty broad spectrum of viability in terms of these census tracts. Some, you might argue, do not need tax incentive to drive private sector investment. Some do. So there are areas that investors would look at that are designated as opportunity zones and say, that doesn't really seem to fit. Right. And the answer is, coming out of the financial crisis in 2010, when that census was done, those areas were in a very different position in terms of their vibrance relative to where they are today.
So you're saying that we've already seen private capital get mobile and move in the direction of those areas that are still deemed these QOZs today?
Some absolutely, some not. So it is a pretty broad spectrum. And as an investor, you can evaluate different offerings in the market that have assets identified in different markets and make that determination yourself. But there's a lot of data available as to changes in college education rates in those areas, median household incomes, household values, and some of them have changed very dramatically over the last 10 plus years.
So, a lot of our clients are asking us about, what do we do the American taxpayer is under fire. At least those that are paying taxes are under fire.
Yeah.
So one of the things that we like to do at South Coast is be proactive. A lot of our clients have engaged in 1031 exchanges in order to mitigate capital gains on their real estate sales. Can you talk a little bit about the differing dynamics of a QOZ investment versus a 1031 exchange?
Yeah, happy to do that. One thing I just wanted to say as you were talking about sort of under fire is, this is kind of one of the rare places where you can do well, but also do good. So the impetus for this legislation was to create long-term investment in these communities, create jobs. And there are some requirements associated with how you place capital in these census tracts. So what is a qualifying business activity? It has to be an active business. So what you see a lot of folks doing is doing things like building housing, building apartments.
Mhm.
And we are underhoused right now in the United States. So creating more housing stock is incredibly valuable, especially as you guys know, being in our business effectively, what we have seen house values move to relative wage inflation, right? For a lot of people, home ownership is out of reach. That's going to be a continuing problem in this country. We need more housing stock. So building apartments in growing markets is a very good thing. So there's a social benefit to this as well as an economic benefit. But the legislation is very flexible to your point, which 1031 legislation isn't, right? So what we're talking about here is gain or part thereof. So you can take a gain or part thereof and invest it into an opportunity zone fund and get the associated benefits. What you wouldn't do is take your basis. So as I think about the appropriate investor thinking about the sale of real estate, really the appropriate investor in my mind is an investor, number one, that has a 10-year time horizon to realize the benefits, right? Tax-free growth. That's really the driver here. The second benefit here is the ability to separate your basis from your capital gain. So if I'm a real estate investor with a high basis, I might want to take that basis back, build a diversified, more liquid portfolio at that basis, and use an opportunity zone fund to mitigate and get to real estate diversification with that gain portion or part of that gain portion. If I have a low cost basis, I'm probably better off doing a 1031 exchange, because keep in mind with the opportunity zone fund, you're deferring your gain and you're reducing it, but you're not doing it in perpetuity like the 1031 allows you to do. So the real benefit here is the ability to separate basis from gain. So it's not just 1031 investors selling real estate that might have a high basis with a small capital gain that want to take their basis back. We see a lot of people that have concentrated equity positions. Obviously, growth equities have run, tech stocks, right? And as a result of that, people have portfolios where certain parts of their portfolio are sort of out of whack with what their real risk tolerance is, right? They've got concentrated positions.
Yeah.
So the ability to reduce those positions, but have a mechanism for dealing with the gain is really valuable here. And then, of course, we see people selling businesses left and right now, low interest rates, very active private equity, and those folks have a tax consequence coming. So this is a great way to deal with it. And you don't have to put the funds from the gain that you're realizing with a qualified intermediary. The source of the investment into the opportunity zone fund doesn't have to be the gain itself. The money is fungible as long as you do it in a timely manner, which is generally speaking within 180 days from realizing that gain. So you have a fairly large look-back period available to investors.
They actually made it pretty easy too, from a tax reporting standpoint, for the CPA to come in. It's like a one-pager that gets added to the tax return. So it's not something that's going to create, a tremendous amount of headaches as far as keeping track of, what did I sell, the gains, all of those things. They've made it very easy.
Albeit, when you're talking about headaches, California is going to raise its ugly head, of course, when you talk about states have to adopt these sort of federal policies. And to my understanding, California is not a conforming state.
That's right. So as a California taxpayer, you get the federal benefits, but you're going to pay California in the current period and on the way out. I think California has made the calculus that this is compelling enough. And for those having liquidity events, California wants their revenue now and they want their revenue later. So they're not going to conform at the state level, but you certainly get the federal benefits. The other question that we get a lot that I think is important to address is, what if taxes go up, or what if retroactively they go up? And what you find in the analysis, which is really interesting, is that as capital gains rates go up, the benefit of the opportunity zone fund magnifies relative to traditional investment. And the reason why is the tax-free growth portion. So imagine you're having a liquidity event, you're paying capital gains tax today, you're investing what is left after paying those capital gains tax today. It's growing over 10 years. And then on the way out, you're paying capital gains tax again. Very punitive from a tax structure environment. In the Opportunity Zone Fund, while you're deferring today, you might be paying that deferred amount at the higher rate in 2027, although you're paying 90% of it, not 100% of it. You're growing the underlying investment tax-free. And so the after-tax benefit of the Opportunity Zone Fund gets larger and larger for investors, assuming the same rate of return as a traditional investment as capital gains rates go up. So I think you're going to see more and more activity in this space. We certainly see it in terms of interest from investors who are worried about what we see in the potential for increased capital gains rate going forward.
So I think just to kind of wrap things up, this is an advanced tax planning strategy where we can actually take gains and defer the tax on those gains
while putting your basis back in your pocket, creating more liquidity.
And we're going to be able to reduce the actual taxes that we owe by 10%, assuming that we hold the investment through 2026. And then if we hold the investment through for 10 years, so 2031 in this case, the investment itself becomes tax-free at that point.
So the growth on the investment becomes tax-free. The gain
you still own the tax on the original capital gain.
You've already paid it. Yeah. You've already paid it, and you paid 90% of it effectively. Right. So it's very impactful from that perspective. The other thing that's important just to note is the underlying investment in these cases, and generally is real estate as we look at Opportunity Zone funds. So there is cash flow along the way, assets that get built, get refinanced. There's interim distributions that are very significant. So for investors that think, wow, I'm parting with my capital for 10 years, I'm not going to see any return on that money for 10 years, that's a long time. For most of these investments that are doing development or redevelopment, these assets, once they're stabilized, will get refinanced. A lot of capital will be returned through debt finance distributions within the first 4 to 5 years, which are tax-free. Then you have operating cash flow along the way, which is very tax efficient. So
sheltered with depreciation.
Yeah, with no basis recapture under the current tax code, because you have a step up, not a capital gain at the end of an Opportunity Zone Fund investment. It's a very tax efficient way of generating income. So again, keep in mind that investor who's saying, geez, I'm 4 to 5 years away from retirement, I've had a lot of growth in my portfolio. This might be an interesting way to take advantage of the tax code now, reposition those assets in a way that's very tax efficient going forward for them over the next 10 years.
I would also add that there isn't necessarily a requirement to create a gain and invest all of that gain in something like this. You could always diversify, get some capital invested here, and then look to pay some of that gain today.
Right, absolutely.
Obviously a strategy that you definitely want to work with a financial advisor on.
And your CPA, of course.
Your CPA, because these can be complicated transactions. But I mean, from a tax saving perspective, extremely effective. So thanks for being on with us today.
Thank you very much. Time with you. Thank you for the opportunity.